Good morning, welcome to Inside India. I'm Dan Murphy. These are your headlines today. First, Indian markets will get their first chance to react to those additional US tariffs today, with textiles, auto components and the jewelry sector likely to see an impact. Nifty futures tipping a lower open. Plus, India's finance ministry saying while the country could withstand the immediate impact, the secondary effects will be more challenging and they must continue dialogue with the US. And Indian Oil inks a 15-year LNG supply deal with ADNOC, making the UAE companies the largest LNG buyer. A warm welcome to the program. Asia markets really looking mixed here. Take a look at the trading day so far, and with regards to how things are stacking up, well, you can see the S&P ASX 200 in Australia, Hong Kong's Hang Seng and the TAIEX pulling lower here, but Japan's Nikkei 225 is up by around 0.5%. We're also seeing gains today across the Shanghai Comp, better by 0.62%. Meantime, we also want to show you shares of Nvidia. Earnings, of course, out after the bell. The AI chip giant beating on both its top and bottom line, but China still looming large over its report card as the AI chip giant left out potential China sales from its outlook. We're going to talk more about that later on in the program, but you can see the stock was down 3.14% last traded. And of course, the India market's also coming back from their public holiday and will be reacting to those higher tariffs. They're coming online in about 45 minutes, but here's what Nifty futures are indicating right now. You can see the market actually expected to push those tariffs to one side. Right now, the Nifty futures sub 25,000, but pointing up 0.15%. So we're going to be watching this really closely when trade gets back underway. The US 50% tariff rate on a number of Indian exports is one of the highest in the world. White House advisor Peter Navarro says India could see a 25% cut if it stops buying Russian oil, adding that Washington must deter both India and China from funding Moscow through energy purchases, going as far to say that the Ukraine war is, quote, Modi's war in an interview with Bloomberg. But the US Treasury Secretary Scott Bessent struck a more upbeat note, telling Fox Business that India and the US will eventually come together. Indian officials, meanwhile, say communication channels remain open to resolve that dispute. Meantime, India's finance ministry is cautioning that new US tariffs could drag on trade and growth in the months ahead, even if the immediate impact seems limited. In its latest economic review, the ministry pointed to tax reforms, lower business costs, a ratings upgrade and a strong monsoon as buffers against the shock. The monthly review also highlighted that trade negotiations with the US are crucial. But with the US as a key market, industries like textiles and leather say they're already seeing orders cancelled. Here's what people on the ground are saying about the US tariffs now.
I don't think the US will be able to survive the tariffs. Trump is taking one-sided decisions despite India being a cooperative nation. He is taking decisions without consulting India. So I think we have to find markets other than the US to boost our trade.
Always when you are in problem, only then the best solution comes. So, and we Indians are known for that. So I think it is a challenge, but India has never gone down. We have never gone down, and we are very sure in some coming months only, not years, we will come back to normal.
Several orders have been put on hold, and some orders have been cancelled. This has created instability in some factories. I think these tariffs will create a far-reaching impact in the future.
Meantime, in the face of those US tariffs, India is pushing ahead with diversifying its energy sources. The latest move is a 15-year LNG supply deal between state-run Indian Oil and the UAE energy giant ADNOC. Starting 2029, the agreement will make Indian Oil ADNOC's biggest client. And on the macro front, India's industrial output data is due later today. A Reuters poll sees activity picking up to 2.1% in July from 1.5% in June. But sluggish output last quarter is expected to drag on Q2 GDP due tomorrow. Analysts estimate growth slowing to 6.7%. That's down from 7.4% in the first quarter. Weak private investment, experts say, could offset a pickup in government spending. So much to unpack now with Trinh Nguyen. She's a senior economist at Natixis, joining us live now for insights and reaction to what has been a super busy week so far on the ground in India. Trinh, welcome to the program. First of all, what are you seeing in terms of the immediate reaction in markets and in trade flows as a result of this 50% tariff now live on India?
Markets are expecting the government to offset this roughly 1.2% exposure of affected sectors, which basically translate to about potentially 60 basis points to GDP hit with proportional fiscal support. So GST, for example, is going to be cut. Also, potentially rate cuts. We think actually there's room for 2 more rate cuts. And maybe even support on the banking sector and local government side to help the affected sectors. Now, while the digestion of this in the short term, it's totally fine because what it shows is that India itself has a very low exposure to trade, manufacturer trade. And that is its weakness that it wants to change. Now, therefore, the ability to absorb it is fine because the exposure at maximum is 1.2%. So we are looking at a very limited impact. But the reality is that this could widen to total exports because currently we have pharma, ICT, energy, and a few sectors that are exempted. The second part of it is that what India wants to do in the future is to grow this further, right? And I think that's why the concern is that support to offset this will have costs, fiscal costs. Secondly, it needs to grow to other markets. And the question is, how can you offset the largest market?
Indeed, that's the question right now. And Trinh, I want your reaction as well to the Finance Ministry's latest assessment of the state of play as well, saying as well that these US tariffs and their impacts look limited at the moment. But it also said that the delayed effects could weigh on growth. So take me inside your base case when it comes to the impact for India's GDP this year. I know you just gave us a small number there, but what makes you so confident to think that this won't have the impact that some others are suggesting?
Fundamentally, I think India has to take that 25% down from oil, which will leave it at 25%. At 50%, even if the short-term impact is manageable, as I mentioned, the reality is that the sectors that are affected have a lot of jobs. So we can have significant job losses. Secondly, it can have a second-round effect on FDI. And third, further widening, worsening trade relations with the U.S. I think all those factors can create uncertainty on the investment climate. That can really negatively impact labor market conditions. And that's a weakness at the moment for India. It has very high informal employment. The second thing is on top of that, it is the largest population in the world, and that's growing very rapidly. So not only is it facing this labor problem now, it's facing it into the future. So therefore, the second round effect is going to be very, very challenging because the buffer to offset it cannot be sustained over the longer term. So for example, to cut GST, that's going to come at a cost to the government. Now, what that means is that it's probably going to lead to more financing needs, meaning more issuance of bonds. Can it do so perpetually into the future when government debt is already very high and India itself wants to fiscally consolidate? That's the reason behind S&P rating upgrades, right? And it wants to continuously have better upgrades and fund itself much cheaper. So I think these challenges point to the fact that India itself, despite being very hawkish, and also on the U.S. side, Navarro is always a major trade hawk. So I would just take that with a grain of salt. But the fact that Besson is actually speaking about the fact that this 25% could go down, I think they will need to go down from both sides.
So, Trinh, it looks like it's all coming back down to the negotiations and the path forward here between the US and India. Of course, a lot of uncertainty about exactly what's going to happen next. Just on the economic outlook, Richard Rosso at CSIS told me this week that India's economic outlook now may hinge less on New Delhi and more on the states. Listen to this. I want your reaction off the back.
Sometimes a crisis is the best opportunity to take the bull by the horns and take big steps. My colleagues were just running across India doing a bunch of visits with state governments. And when you talk about India's commercial viability, frankly, most of that is not things Modi controls. Companies need electricity, they need water, they need sanitation, they need licensing. Most of that's controlled by state governments. And a large number of India's more developed state governments, too, are very concerned about the lack of progress on trade talks. And they're trying to get their own house in order as well.
So would you agree with that? Do you think that the focus should be on state-level reforms as well, rather than just central government policy here?
Absolutely. A lot of states have done really well in attracting FDI, particularly footwear and so on and so forth, whereas others are not. I think that the issue here for India regarding tariffs is this. We're talking about growth. It's in the 6-ish%. India has ambition to grow 8%, right? The tariff hit will probably, if it stays, going to leave India in the 5-6% range versus going up to the 7 and 8%, which is what it needs to grow significantly. And I think India would choose the latter. It's not so much that the U.S. is irreplaceable. It's just that, yes, it can expand trade to the EU. It can expand trade to BRICS, but currently total exports to the U.S. is higher than BRICS. EU and the U.S. combined are 2 times the size of BRICS. So there's room for BRICS to grow, but the reality is that it needs to export to the wealthiest and the ones that are willing to import more of these goods, right? Versus BRICS, which is basically, a lot of them are India's competitors, namely China and so on and so forth. And so for India, the choice is very simple. It's not about survival, it's about prosperity. So in the short term, it may choose sovereignty and so on and so forth. But in the longer term, it would choose prosperity. And prosperity doesn't necessarily have to come from trade. It can come from lubricating trade domestically as well. The challenge for India, and the reason why, despite having the largest labor force in the world, that's underutilized. Labor-intensive manufacturing, it's only half of that Vietnam's, and only less than a tenth of China's. So what that means is that there is a lot of domestic capacity that can be absorbed. They are importing a lot of deficits, with Asia. Only the Philippines has a surplus with India. So therefore, I think there's a lot of opportunities externally and also domestically. And where are those opportunities? Those opportunities are coming from not standing in the way of scaling up in India. India, as it is, incentivizes smaller scale production, smaller scale labor force because of very rigid labor market rules, right? It doesn't encourage firms to scale up, rules that cause firms having to involve the state and so on and so forth. So I think there is a lot of room for reforms. The question is, beyond GST, will Modi, as that gentleman said, seize it by the horn and then use this as an opportunity, this external shock, to really liberalize India, to boost domestic investment, private capital capex domestically, which eventually will create such competitiveness that it can also be very competitive offshore, be it with the U.S. or not.
It's a really good point, and this is a central theme that's been coming through in a lot of the conversations that I've been having this week. Most people are saying that these tariffs are going to accelerate the domestic reform agenda in India, which can only be good news long term. Trinh, at the same time, the US Treasury Secretary was actually asked in the last 24 hours about India's push towards Russia and China, and I want your take on this as well. You mentioned BRICS just now. He was asked whether or not that it would be a concern if India moved to do more trade with the BRICS nations, perhaps even using more of the rupee in that trade rather than the USD. Is that something that concerns you?
Well, not exactly at the moment. If you look at India's trade with Russia is a good example. India imports from Russia. It doesn't export that much. It exports roughly about $5 billion. And if that trade were to grow 50% over the next 3 years, which is what they want to do, is grow total trade. So if we just use exports, then we're looking at a $7.5 billion market here in 3 years, right? So that's less than 10% of its exports to the U.S. right now, even with this a benchmark of aggressive growth. So what I mean by that is that, yes, these are things that India can do to diversify. But the reality is there's a reason why the U.S. is the biggest market for India. Natural gravity tilted towards this highest margins business. It can continue to sell gemstones, shrimp, textile, and so forth, outer parts elsewhere. But it's not easy. If it were easy, those markets would have taken a much higher share than the U.S. at the moment. So further liberalization of hurdles would help. But the absorptive capacity of the Russian economy is limited. So the second one is to look at India trade with China. India trade with China is very asymmetric as well. It's very different than Russia in that India imports an essential, which is energy, whereas its trade with China is all over the place. It imports intermediates for manufacturing. It imports final goods. It imports labor-intensive goods. And this is a point I want to highlight. A lot of people say that actually the trade deficit with China just reflects India's eventual exports elsewhere. The reality, yes, but also the reality that India is also importing a lot of goods that could have just been made in India itself, but isn't, for the reasons mentioned below, is that Indian firms do not have the incentives to scale up and produce in India. They find it more economical just to import from China. And those import data, the huge blowing out of the deficit, is during the years where India's have a very difficult relationship with China, which is warming up. So the point here is to say that, yes, there's plenty of room for India's exports to China to grow because China is a big market. But the question is, why hasn't it? And what would it take for it to grow? And I would say that's a very difficult one for India to tackle because it is not competitive. And therefore, that's why it has a trade deficit and a huge trade deficit with China. And therefore, I think there's a limit to this pivot to BRICS. So despite of the very hawkish rhetoric, I fundamentally think that the future of India is still a lot of trade and a lot of trade with the US, with the EU, with BRICS, with wherever it can trade. And the one way it can do that very competitively is to make sure that its domestic sectors are not being held back.
Trin, a few more rapid-fire questions before I let you go here. You flagged this earlier, but of course, Fitch didn't follow through with the S&P ratings upgrade. What do you think these tariffs mean for India's sovereign rating momentum?
Well, the big question is, again, as I said, there's no free lunch. India can offset this, obviously, because it's a very domestic-oriented economy, not external. Domestic demand is king in India, and that's why it's very sheltered from global turbulence. That being said, to offset this loss in exports, should they continue with the 50% tariff, India will need to spend more, right? It needs to spend more to offset the income losses. It needs to spend more. How is it spending more? It can either reduce taxes, which is what is being highlighted, the GSC. It can also spend more via expenditure, right? Expenditure to target it to sectors that are affected, expenditure to just income support in general. All of these things means that it's going to probably have a wider deficit because if you lower taxes and you spend more, you're going to have a wider deficit. And this is an area that India wants to tackle. And one of the key reasons for it to have an upgrade. India is very different from China. China has a huge private debt balloon that it needs to climb down where the central government is lean. India private sector debt is very lean, but government debt is very high. And what India wants to do is to lower the stock of debt or at least borrow less over time so that the stock doesn't grow too aggressively, and then telling the private sector to do more. But what's really happening with the tariffs is that the private sector, particularly the export-oriented sectors, are being hit. So the government, once again, sees itself being the one that has to stimulate demand. And it cannot consistently do this with the goal that it has, which is to improve its ratings by continuing to expand the government capex, government spending, without punching a larger hole in the deficit, which goes against its longer-term goal, which therefore goes back to my thesis, and which obviously a lot of people find a huge contradiction, is why is 50% tariffs still mean India has to do more trade? I do think the future of India is more trade, not less. And so therefore, it needs to get rid of this 20% to 5% tariff. It is in the US and India's interest to get rid of it. How it does so and when is a big question mark, but I'm pretty sure it will because it has a huge second round effect for India, even if the short term is mitigated.
Trin, we've got to go. We'll leave it there. Thanks so much for your analysis today. Always appreciate it. Trin, you were there from Texas. Up next on the program, Nvidia's earnings are out. AI demand soaring, but global uncertainties are looming. We'll break it down after this short break. Stay with us. Back to one of our top stories this morning. It is, of course, Nvidia. As we mentioned earlier, the AI chip giant beating estimates, but the stock did not feel that love. Our China reporter Elaine Yu joining us live now to tell us why and to take a deeper dive into the numbers. Hi, Elaine.
Hey, Dan. So investors have come to have a very high expectation for Nvidia, but its revenue from the data center segment did slightly miss estimates. But weighing on Nvidia's outlook is the uncertainties around China. So the company says it's not anticipating any H20 sales, the chips designed for China, to the country for the foreseeable future. They cited geopolitical issues, but they did manage to sell $650 million worth of these H20 chips to a customer outside of China. So it's not a total write-down there. But now Jensen Huang is working hard to get a chip based on Nvidia's top-line products, the Blackwell architecture, approved for China. Let's take a listen.
We're talking to the administration about the importance of American companies to be able to address the Chinese market. And as you know, H20 has been approved for companies that are not on the entities list, and many licenses have been approved. And I think the opportunity for us to bring Blackwell to the China market is a real possibility. And so we just have to keep advocating the sensibility of and the importance of American tech companies to be able to lead and win the AI race and help make the American tech stack the global standard.
And earlier, Trump did hint that he could be open to a Blackwell chip for China as long as it's not as good as the ones used in the U.S. So Nvidia may have to thread this needle of having a chip that is not so good to satisfy the White House, but also good enough for Beijing to deem it useful for its AI race against the U.S. But China watcher Bill Bishop made the point that Huang reiterating the importance of making the American tech stack the global standard is an argument that will help him with Trump, but could backfire with Xi Jinping. Dan?
Elaine, really interesting. So take us more inside the Beijing playbook here. What is China doing when it comes to being self-reliant?
So it is now ramping up AI chip capacity. And if you look at Cambricon, the Beijing-based chip maker, which is seen as China's homegrown challenger to Nvidia, they posted a more than 4,000% surge in revenue in the first half of the year. So that does show that domestic rivals or alternatives to Nvidia are gaining traction in the country. And China's chip makers are also trying to triple the country's output for AI chips, according to an FT report, to reduce that reliance on Nvidia. And Huawei is aiming to start production, the report says, at a plant for AI chips at the year end, and with 2 more facilities set to launch next year. And also, if you look at DeepSeek, they said on WeChat last week that their data format for its newly released model is tailored for next generation domestically built chips that will be launched soon. But at the same time, Beijing has to balance its push for tech self-sufficiency with the fact that many companies in China's cutting-edge industries, from autonomous driving to robotics, do still want these Nvidia chips. And with its Blackwell, it is known for its energy efficiency. Huang talked about that at the earnings call. And when you had that high level of energy efficiency, it does translate to revenues as well, as data centers, he said, do have limited power. So we'll have to watch very carefully how that Blackwell push develops in China as well, Dan.
Elaine, great stuff. Really appreciate your reporting on such an important story. That's Elaine Yu there. Moving forward, and India is also pushing through with its semiconductor mission, with 10 production units approved across the country and the first made-in-India chipset to come out by the end of the year. The country approved 4 new projects worth nearly $20 billion this month. Coming up on the program, we'll discuss the outlook for Indian markets as the 50% US tariffs come into force. Stay with us, plenty more ahead. Inside India, we'll be right back. Welcome back. You're watching Inside India. Some of the other stories we're keeping tabs on today. Prime Minister Modi heads to Japan tomorrow to meet PM Shigeru Ishiba. The two countries are set to upgrade their security cooperation and launch a new economic security initiative on semiconductors, AI and critical minerals. Modi will also visit Sendai, Japan's chip hub, as New Delhi and Tokyo deepen ties amid tensions with the US. Flash floods and landslides have killed dozens in India this week, and heavy rains are battering Pakistan as well. Officials in Islamabad say they received warnings and immediately issued alerts for flooding on three major rivers that flow from India. Both countries have experienced intense monsoon rains in recent weeks, with the death toll in Pakistan now running into the hundreds. A video simulating the potential fallout from an eruption of Japan's Mount Fuji is making waves on social media. The Japanese government released the AI-generated film to warn the public about such a scenario. The footage shows volcanic ash paralyzing transport systems and severely impacting public health across the region. Back to the markets now and a quick check on gold for you. Prices pulling back from what is a two-week high as investors wait on fresh policy signals ahead of the Friday PCE price index. That is the Fed's preferred inflation gauge. You can see gold down by 0.2% now, $3,390 US an ounce. And we're also counting down to the market open in India. Here's how Nifty futures are shaping up. We flagged for you earlier that the market is expected to open slightly weaker here in reaction to the 50% tariff now in effect. Let's get more on what to expect with Niket Shah. He's the CIO at Motilal Oswal Mutual Funds. Niket, welcome to the program. First of all, the finance ministry here saying the fundamentals remain strong, but give me the mutual fund perspective here. Is that necessarily what we are expecting to see when trading gets back underway today?
Absolutely. I think there are two things which are at the top of the mind as far as Indian markets are concerned. One is the 50% tariff which gets into effect from today itself. Now, if you look at the math, India roughly exports about $90 billion of goods to the United States, of which if you remove the exempted list, which is electronics, pharma, and some more other stuff, you are left with roughly about $50 billion of net impact. If you take that impact into picture, that's roughly about 60 to 70 basis points on GDP. But government has recently announced a series of measures that they will announce in the next 75 to 90 days. One which has already been announced is the GST cut on goods, which will get hopefully effective by the end of September. Now that clearly shows the government intent to stimulate the domestic economy to offset the impact of United States tariff. So if we are able to see a GST cut, it should roughly help about $20 billion of stimulus from government. And that should be another 70 to 80 basis points of benefit to the economy. So net, I think it should be neutral for the economy as such. And hence, we believe that the fundamentals of the economy continues to remain fairly strong.
So, Niket, if that is the case, why is the rupee now Asia's worst performing currency this year?
Yeah, so the net impact is about $50 billion, right? So if you take that into consensus, it's roughly about 1.3% of GDP. And if you look at from a balance of payment standpoint, we will see that impact as we see this US tariff playing out. I think one thing to keep in mind is that most of the enterprises and corporates whom we speak to who are impacted because of the tariff, largely on, say, textiles in particular, some of the chemical names in particular, most of them have at least ensured that they have supply to US till the November or the December end month. So if the tariff issues are solved before December, I think the impact would be fairly minimum, and you will see rupee coming back to about 85 to 86 levels. But if you see that the tariff issues are not solved by December, we could see some more depreciation going forward as well.
More depreciation. How much more downside do you see for rupee, at least in the short term?
I think closer to 89 to 90 could be a possibility if the US tariff continues beyond December, given the impact that we would see on the balance of payment.
What we've also seen is bonds and currency markets slumping ahead of these new levies as well. Do you think investors are pricing in more downside to come? Obviously, the futures picture today indicating a softer start when trading gets back underway. But what would you say is the short to medium term direction of travel in terms of market sentiment and direction on India markets right now?
I think the timing of Trump tariff was kind of a bit surprising to us because the country, if you look at post-election, there has not been any major reforms from the government till now. And all the high-frequency indicators, whether it's GST collection, tax collection, had seen signs of weakness. And US tariff coming at a time where domestic economy has been slowing down has been a double whammy for the Indian markets as such. Now, this comes at a time where the valuations has been reasonably expensive. And hence, FIs have been net short in India today from a derivative standpoint, as well as we've been seeing at least $2 billion of selling every month from FIs. Now, the good news is that if the government is able to pull up the reform process, which they have recently announced, then we should see some short covering towards the second half of the year. And that is why we are actually bullish at current levels. We believe that the worst is in the price, and with government reforms around the corner, hopefully we should see better days going forward.
Indeed, as you were saying, Indian equities seeing around $5 billion in foreign outflows since July. So we're seeing money being pulled out of these markets. But at the same time as well, others have told me this week that this is an opportunity to buy into that pullback, maybe an opportunity to buy the dip. You agree with that?
Absolutely. I think the domestic flows has been very, very strong in India. We have seen net inflows of roughly about $3 to $4 billion every month from the domestic institutional investors and the retail participants of India as well. So that's kind of cushioning a large amount of FI outflows and keeping markets broadly at the similar levels where we are. So we do expect some consolidation with a positive bias once the reform starts playing out.
Okay, so walk me through how you want to be playing this right now. What sectors within the market are most exposed to what will likely be weaker exports, and what are most insulated right now? Where do you want to be deploying capital?
I think clearly the government focus has now come on consumption in a meaningful fashion. GST cut is one such thing. I think we will see the 8th pay commission hike next year. So that should again boost consumption in India. So I would think consumption is generally where the positioning has been meaningfully underweight over the last couple of years. So we do expect some bit of overweight position, over the next few years to play out there. We also see very, very strong growth on the NBFC part of the business, where we are seeing banks' credit growth being roughly about 8 to 9%, but we are seeing NBFCs growing at 25 to 30% even now. So that's, again, a great part of the market to stay. And last but not the least, we still believe that manufacturing is a way to go. The only silver lining within the entire macro data is that the electronics export from India is still growing at 50% on a YOY basis. And that's showing no signs of slowdown. So within manufacturing, I would think wires and cables and electronics are the silver lining to really look out for.
And Niket, of course, you're looking at this from a mutual fund perspective. What do you want to be avoiding right now as well?
Well, I would think, banking is something that we would love to avoid given the rates are likely to go down further. We expect one more cut from RBI and NIMs will be under pressure. We are also seeing some pressure on credit costs for most of the banks. So banks are something that we have been generally underweight in India over the last 1.5 years. The second sector that we would continue to be underweight is the textile and the large cap IT. So these would be the two spaces, given the macro environment, we would love to stay away from them.
You also just mentioned that you expect another RBI cut. Do you think the RBI needs to cut 50 basis points to cushion the blow?
I think RBI has done a fantastic job by infusing meaningful amount of liquidity in the system in the last 3 months. The net surplus today is about 2.5 lakh crore. And if you include the government unused balance with RBI, that's about 5 trillion INR. So the liquidity in the surplus is very, very high. RBI has been nudging the banks to go and lend aggressively in the marketplace. And what we believe is that about 25 basis point cut should really do the magic. We don't need a 50 basis point cut at this point of time.
Okay, so looking out for 25. When specifically?
I think the next RBI meeting should definitely see a 25 basis point rate cut.
Okay. Also wanted to ask you about what we're seeing right now with regards to the translation for GDP growth as well. And obviously there's plenty of estimates out there about how these tariffs are ultimately going to impact the domestic economy. For its part, Citigroup saying the 50% tariff could shave 0.6 to 0.8 percentage points off GDP. Seems like a pretty conservative estimate according to others that I've spoken to this week. But how do you think the pullback in GDP that is expected is going to translate into corporate earnings growth as well? This appears to be a concern for anyone who's moving money in these markets right now.
Yeah, so I think I would kind of agree with the GDP estimate that some of the sell side would have put out, which is 60 to 80 basis points of impact because of tariff. But I think it's quite important to keep in mind the benefit that we would get because of GST cut would again be in the range of 60 to 70 basis points. So kind of sets off each other. But the good thing is that I've generally seen over last decade, in every crisis, India wakes up and kind of uses that as an opportunity to grow meaningfully. And given the fact that the current crisis, which is on tariff, it has actually waken up the government. And we are now seeing, significant amount of action and sense of urgency from government, which in some sense was missing in the last 1 year post-election on the reform side as well. So we do expect the next 100 days to be action-packed on reforms from India to cushion the impact of the United States, but also, further strengthen the domestic economy on its own.
Yeah, and that's one of the most interesting angles here as well, because there is a broad view now that this is going to accelerate domestic reform momentum, which is really important too. Nikkei, on another point here, just with regards to what you were mentioning before, of course, there is talk about the changes to GST. That's also providing somewhat of a sentiment move higher. At the same time, more talk of an RBI cut. Is there anything that policymakers need to do to shift the direction of travel or shift sentiment within the markets right now? What would you like to see from the government in order to restore confidence in the aftermath of this huge tariff impact?
No, I think the government is taking all the right steps. I think taxation reduction would be a great step in that direction. Please keep in mind that a 10% reduction in GST doesn't increase the growth by 10%. I think there's a multiplier effect to that. So if there's a 10% reduction on taxation, right, the impact would normally be 2x of that as far as the economy is concerned, right, from a growth standpoint. So I would think, I would love to see taxes going down, which I think the government is doing. I would see some reforms on the labor side of the market, which again, I think hopefully the government should kind of bring in as well. I would expect, some news flow on semiconductor as well. I think the semiconductor exhibition goes live on 2nd of September in India. So we are expecting the ISM2 being approved by the government of India. So on the manufacturing side, on the semiconductor, on the electronic side, the government is putting all possible effort to stimulate growth out there. But the area where there was weakness, which was the domestic consumption, I think with the GST cut, we should see that picking up meaningfully. Now, if US tariff issues get sorted out before December, then I think that will be a great bonus. And that would ensure that the economy would continue to grow at north of 7% even for next year.
Yeah, and it leads me into my next question, because I think what we are seeing here is likely to be short term. A lot of people I've been speaking to are saying to me that, look, these tariffs are impacting now, but don't necessarily change the long-term thesis for India. So when it comes to actually getting the deal done, Nikkei, I know this is a hard question, but can you put a timeline on it? Obviously, there's momentum on both sides. The conversation corridors are still open. When are we going to see tariff relief in India?
I think it will be closer to the end of the year is the hope. But at this point of time, it doesn't look both the sides are willing to budge at all. But, given the backdoor talks that have been going on, our sense is that it would take a couple of more months for any conclusive evidence to really come through.
Final question here. I want your take on what's happening with gold as well. Really interesting price moves here. We've seen gold coming off what has been a 2-week high. Walk me through what's moving gold right now and where you see it going.
Oh, multiple reasons. I think the whole geopolitical reasons as well as the interest rate environment has kept gold on its edge. We don't have a specific view on gold as such, but generally I think there have been a lot of moving parts. A lot of countries, including China, has been on a buying spree since a long time. So has been India on a buying spree on gold. But I would think that gold should head up northwards from here as well, given the fact that some of these geopolitical issues are not getting sorted out in the near term.
Yeah, and do you think the upward move in gold is also perhaps a reflection about concerns around valuations in the India markets right now? We've been flagging that the Sensex is trading 23 times X, also concerns about where the Nifty 50 has been moving as well. Are you concerned about valuations right now?
Yeah, for sure. I think if you look at the last 4 years, earnings growth for Nifty companies has been roughly about 20 to 23%. But in the last 1 year, that growth from 20 to 23% has come down to about 8 to 9%. And if you take that in context, and if you look at valuations, we have not seen meaningful deceleration in valuation. So it continues to remain in the rough range of about 21, 22 times, which is clearly on the higher side. But the good thing is that on the mid caps, the earnings growth continues to remain strong at roughly about 15 to 16%. But again, out there, we have seen some reduction on the valuation side, but it's still, I would say, 2 standard deviation higher than the last 10-year average. So I would think that India needs to cool off a bit as far as valuations are concerned for it to become far more lucrative for the next leg of rally.
Niket, appreciate the conversation. Thanks for coming on today. We'll speak again soon.
Thank you so much, Frank.
Niket Shah there from Motilal Oswal Mutual Fund. And an update on the national security trial of media tycoon Jimmy Lai in Hong Kong. The court has just wrapped up hearings and will announce a verdict at a later date. Lau is the founder of the Apple Daily and has been detained since 2020 on conspiracy counts alleging collusion with foreign entities and printing seditious articles. Well, up next on the program, India markets have just joined the trading day. We're going to be back with the top movers in Mumbai after this short break. Stay with us. We're back with a live look at the dollar index right here, right now. We're, of course, keeping tabs on what's happening over at the Federal Reserve and the fallout from Trump's attempts to fire Lisa Cook. The New York Fed President, John Williams, stressing the importance of the central bank's independence in his interview on CNBC overnight. Here's more of that conversation.
Personally, I have worked with Lisa Cook when she's been a member of the Board of Governors, and she's always brought, integrity and a commitment to the Federal Reserve's mission. She's a very esteemed and highly respected economist. But I think the broader picture, obviously, is that, I think Federal Reserve central bank independence is very much very important. It's important not because it's convenient or anything like that, but because it's we know from history, from experience, that independent central banks can deliver low inflation, economic and financial stability. And we know the structure of the Federal Reserve is such that it's designed to have independent policymakers who are making decisions. Decisions affect the economy over the longer term, away from short-term political pressure. And I think that's really, really important.
But if the president can fire somebody based upon allegations, does that threaten the Fed's independence?
Well, again, I'm going to just speak to the importance of the independence, and something that, I think is proven to be valuable around the world. We see countries throughout all the continents really have turned to having independent central banks like we do, so that you can get the best outcomes for the people of the country, and in our case, for the United States, and quite honestly, for the world. The Federal Reserve is obviously very central to the health of the U.S. economy and the global economy.
Move on now, John, to your outlook for the economy. GDP has slowed. Payroll growth has slowed. How much concern do you have that the economy is weakening or softening here?
Well, it's absolutely true. GDP growth has slowed in the first half of the year, roughly 1.25% growth at an annual rate relative to about 2.5% last year. My expectation is that's going to continue through this year, but that's a slowing economy. It's not a stalling economy. We look at a broad set of indicators. I think we're seeing kind of an economy going through an adjustment process, partly the continuing adjustment from post-pandemic, partly an adjustment to some of the policy changes that have happened, including trade policy. So I see that as something that's been ongoing. I'm watching very carefully, watching all the indicators in the labor market, spending. So my view is the economy is growing, will continue to grow. For the year as a whole, maybe 1 to 1.5% annual rate, a little bit, like I said, a little bit slower than last year, but still positive momentum going forward. But I'm watching that data very carefully.
Okay, let's take you straight back to the India markets now. They are, of course, online. The Nifty 50 looking like this, and you can see pulling back by more than half of 1% now, sub 25,000 on the index. So a 0.6% pull as a result of this 50% tariff now in effect. Let's get straight out to CNBC TV 18's Hormuz Farakia for a deeper dive into the market reaction. Hormuz, what are you seeing right now?
There's a start under pressure for our markets and on expected lines as well after that additional 25% levy from the Trump administration took effect yesterday morning. Of course, yesterday was a holiday, so trading has resumed today and it started off on a weak footing. The Nifty, the benchmark index, already had seen a big fall on Tuesday's session. Not just that, it closed below some important levels as well. So now, as a result of which, it is continuing to see further downside. There was selling pressure across the board. The broader markets too are feeling the pinch here. The mid-cap index on Tuesday was down almost 1,000 points. It's extending those losses today. An outlier though has been the banking names, the bank index, which has a majority constitution on a weightage on the benchmark index. That is feeling the pressure and that is taking the Nifty lower along with it as well. And of course, the tariff-related impact on sectors like textiles, on chemicals, on gems and jewelry, and of course on the seafood exporters as well. All of these stocks have opened lower with losses of anywhere between 2 to 4% in today's trading session. But a banking index is feeling the pressure simply because there are asset quality concerns that have risen, especially because of their exposure to these sectors. And in case any relief measures are announced, that could further pressure asset quality that was already under pressure during the recently announced quarterly numbers as well. So it is a start on a weak footing. The Nifty currently trading below key support levels. It will be interesting to see whether there is some reversal that comes in towards the later part of the day, particularly because it is also the monthly expiry of the futures and options contracts today.
As you've been hitting the phones and asking companies about the impact here, what are they saying about how they're going to be affected by these new tariffs?
But there is consensus across the board with regards to these companies that this 50% tariff levy makes them almost unviable for businesses. We spoke to a lot of these textile companies, a lot of these gems and jewelry companies. We spoke to a company called Pearl Global, and they mentioned to us that the companies that they are dealing with in the US, their clients are demanding for either a 15 to 20% discount, or they are expecting production to be shifted to other countries barring India so that they can offset the impact of these tariffs. They've also mentioned mentioned that half of their garments business is dependent on the US market, and if these tariffs stay, that will result in a export shift of almost $6 billion and also keep almost multiple jobs at stake. So this is Pearl Global, and a lot of these companies, be it Gokuldas Exports, be it Wellspun Living, all of them derive anywhere between 50 to 70% of their top line from the US market. So they have been under pressure ever since these tariffs were put in place, and now in today's session as well, they are seeing some pressure. I spoke to some shrimp feed exporters, be it likes of Avanti Feeds, Apex Frozen Foods, Waterbase. They are yet to quantify the impact of these tariffs, but even these companies, they get around about 50 to 60% of their overall revenues from the US markets, and they too are currently trading under pressure in today's trading session. Now, for the impact when it comes to these gems and jewelry sector, most of this impact comes either from the unlisted space, not particularly so for the listed companies as such, but the unlisted companies, because India is a very large exporter of diamonds to the US market. We also spoke to the chairman of the Gems and Jewelry Export Promotion Council, and he mentioned to us that the US is the largest export destination for India, with exports ranging anywhere between $9 to $10 billion. So it's a very big market for them, and they also mentioned that this industry cannot work with a 50% tariff levy, and it makes them nearly uncompetitive in a market like as big as the US. So what they also mentioned is the fact that 70% of these jewelry exports happen right here from Mumbai in the Seeps area. From here is where most of the jewelry exports take place. Surat in Gujarat, which is a very major diamond hub, that too is facing a bit of pressure. Some areas in the southern state of Tamil Nadu, they are the ones that are taking a major hit because of these tariffs. That is a major export hub as well. So most of these sectors, be it gems and jewelry, textiles and chemicals, that are the ones that are taking the hit in today's session.
Hormaz, we'll leave it there. Appreciate your reporting. Thanks for joining us today. And that's all we have time for today on Inside India. Stay with us here on CNBC. Access Middle East is coming up next.